Nice silence. The net income you can take it from the income statement. Okay. So the net income is the net income will be adding the non-cash charges and then what guys? Non-cash charges then?
Interest.
Working capital investment.
अबे नहीं फुल है
I'll just check it and then you come back.
Okay. Now listen guys. See, to the net income you need to add the non-cash charges and then you add the working capital investment. Sorry, then you deduct the working capital investment and the fixed capital investment and add interest. So now look at it guys. I told you your net income plus your non-cash charges minus your working capital is, what is that? That's our cash flow from operations. So the best thing you can do is you can just take the first three collectively as you can simply take the cash flow from operations. The cash flow from operations. What's the cash flow from operations? You can directly find that from instead of taking that net income, you can directly take the cash flow from operations. So the cash flow from operations okay. Then guys, now listen carefully. We need to find the fixed capital investment. The fixed capital investment you can deduct the, how will you find it? The fixed capital investment? The difference between the property, plant and equipment for the last year to this year. Will you take the net or gross? One minute guys. All of you. In cash flow from operations, do you take the net or the gross property, plant and equipment? I'm sorry, free cash flow. Net or the
gross because
fixed cap? What are you finding? The fixed capital investments. How do you find the fixed capital investment? If you take the difference between the net property, plant and equipment, will it be alright?
we already accounted for non-cash
Fixed capital. Now listen, you should be taking the gross, not net. Why? Because this is net of depreciation. So you have to take the gross amount only. So you need to find the gross property, plant and equipment. If you do not have it, you can take the net. So in this case, the current year minus the previous year. Alright, and the interest is going to be where will you find interest? You have the statement out and you have the income statement. There you will be able to find it. So that is going to be 754, which is here. And into net of tax. So what you have to now do is go to the Now listen. Guys, now the least you should do is do not listen and come back to me later. I'll seriously be mad at you. You check for the tax rate in your financial report. Okay. You will, guys, listen. The tax rate do not. We need. Don't listen. See, the tax rate typically will be given in the income sorry, not from the income statement. You should take it from the report. In the report, they will be mentioning about the effective tax rate. So here, you look at the effective tax rate. It is 25.2. So that is what you need to take. One mistake you do in the valuation is now listen. One mistake you might do it is in the income statement you have your interest expense. Okay. I'm saying so guys, there are two interest rates given here, so I will be taking both of them. Okay, guys, now listen. One mistake you might do is you will take the tax here. Do we have the tax here? Tax expense not given. Okay. Guys, one mistake you will be doing is you might think that you can find this income tax. I'll put it in the paper. Do not do this mistake. You may be able to get this EBT. You may find income before tax as one amount. And then you know how you find the net income is basically EBT to 1 minus tax. Alright, please do not equate net income and EBT and find the tax rate. The reason why I'm telling you is, guys, the applicable effective tax rate should be taken from the report and not calculated from the income statement. The reason why I say it is, in the real world, your income tax expenses need not be just like this. Do you know from where you get the income tax expense? It is from the tax reporting is you will be taking the income tax expense. Okay, now you have these three figures.
सही है
What is a free cash flow to the equity? To the cash flow from operations, you will be deducting the fixed capital investment and you will be adding the interest. So this is your FCF of 0. Is there anybody who didn't get this? Okay. Now guys, your free cash flow to the firm is for year 0 is this amount. You need to be very, very careful from here on. Now guys, you need to project the growth rate. This is the real world valuation. And by the way, this is what, if you take many of the financial modeling classes, you'll be paying the same, you'll be learning the same thing at a rate of 75,000. Okay, the growth rate now from the first year, 0 to 1, first year. How will you project the growth rate? Intuitively, in terms of business, how will you find the growth rate? Huh? Compared to previous year? Is that sensible? No? Sustainable growth rate? Sustainable growth rate, fine. Fair enough. What else? Industrial? Okay. Now listen, all of you, how you have to project your growth rate for the next 2 years. You have to check the industry growth rate. Now, what industry is this? Caterpillar. This is Caterpillar's. What industry is Caterpillar? Heavy equipment. Heavy equipment manufacturing. Okay. All of you, for your respective industry, you please check the growth rate for that industry. That can be taken from any relevant sources like standard S&P or Moody's or Finch, any of these rating agencies, or the government's data will be there. US government's data will be there for the growth rate. Okay, guys, the first and foremost thing you have to do is find which industry your company is in. Are you all aware of which company?
Mine is into multiple industries.
So, if that's the case, you should actually check the company's own website. They'll have their primary business as something they'll be saying. Okay. For example, if the company has say 2 divisions, say take the case of Boeing, they have commercial aircraft manufacturing as well as defense aircraft manufacturing. Both will have different growth rate. You can actually club that and you can say suppose one is 10%, other is 13%. You can take a middle point, something like that.
Mine is into 4.
Maybe you can take the weighted average. If they weight, say 80% of their business is in commercial, then 80% into 10% plus 20% into 12. That estimation is yours. Your growth rate estimation is going to be very crucial. And remember, now this is where you need to play it very, very interestingly. How will you find your growth rate? It is very difficult for you to find the growth rate for every year, so you need to estimate. Obviously, you need to estimate. Suppose let's start. You take the case of say your industry and the average growth rate is or projected growth rate. More than the average growth rate, you have to take the projected growth rate. If the projected growth rate is say 10%, start from there. Now you can assume that this is where you need to put your assumptions clearly. For the 5 years or next 10 years, it will grow at 10%. This is purely your discretion. This is where you need to apply your logic. You can even say put only for 5 years it is going to be 10%. After that, if you have a reason to believe that it will drop to 9%, take it as 9% for the next 5 years or whatever years, 5 or 2 years. And if you believe 10th and say 10th and the 12th or 11th and the 12th year, it will grow for next years for say 11%, you can do that as well. So you need to project it, but ideally it should the growth rate should be it will be going down. Remember, that's why I told you yesterday I have drawn you the industry life cycle. Remember, it will go like this, it will have a high growth, then the growth rate flatten and it will go at constant. And the long term growth rate, how much it will be? What's a long term growth rate? What's the growth rate? How much? In value. In value, 3%, approximately 3%, even 3 to 5% is acceptable. 3% is the long-term growth rate, which means you project the growth rates and finally the growth rate will fall into 3%. Okay, now I'm just putting, I'm assuming every, say every 5 years, 1% growth rate will fall. Then it will be 7%. Again, like I said, it is my assumption. Then the next, say 10 years, I'm just putting as 5%. Again, this shouldn't be random. You need to come up with your own intuitiveness. So guys, does the cash flow end after 30 years? You have 31 to infinity, right? How will you find that value of that? 3%. That's a growth rate. So it will be 3%. My question is, how will you find the value of this free cash flow from? Sorry?
DCF. Cash flow.
Yes. Which one?
Gordon.
The one written there. This one. All right. So year 3 to infinity, the value of year 31 to infinity, the present value of that will be found to which year? Year 30, just the year preceding. So how much will be that? Okay, we'll see that. Let's take the cash flow. So now let's do this growth rate, the last year's, the current year's into 1 plus 10%. All right. Could be. Now you need to extend it for 30 years. So now you have the whole 30 years cash flow, and 31 to infinity, how much will that be? This into 1 plus 3% divided by WACC minus the growth rate. Now you need to find the WACC. You know, all of you would have found the cost of equity, right? As part of the last exercise, you didn't do the WACC, right? You didn't do the WACC for the last assignment, right? But you have done cost of equity, right? Okay. I'm just putting the WACC as a 14%. Randomly, you need to find it. Now see the value. Year 3 to 31 to infinity is okay, guys, all of you. Now listen. See, remember. Listen carefully. Let me reiterate the steps. What you have to do is first, you need to find the free cash flow, current free cash flow to the firm, to the cash flow from operations. You deduct the fixed capital investment, and plus you add the interest net of tax. And the tax rate, you need to take it from the report. You will get the current free cash flow to the firm. Then what you have to do is, you need to find the growth rate. You need to estimate. So this is the estimated growth rate for 30 years. After that, 31st to infinity, you can take 3% or 5% or 4% depending upon you. You project the cash flows. Jeffrey, can you please read? I said, once you project the total cash flows, you can value the firm using the value of the firm using the NPV. Okay, listen carefully. What you have to do is equal to NPV. Equal to NPV, then you select the rate. Then all you have to do is select all those cash flows. Okay, now we got the total value of the firm. Okay, you need to now find the value of debt. Okay, guys, I asked you to take the market value of debt. It may be difficult for you. You can settle with the long-term debt. All right. So the long-term debt here is these two collectively. Sorry, that's not the answer. Value of equity is
5 मिनट का वीडियो है।
शायद लास्ट टाइम रिकॉर्ड किया था वो 30 मिनट्स का था।
हो जाएगा भी। उसके बाद कैब है। दिमाग फक हो जाएगा कैब में।
okay, and this amount will be in millions. Agreed? Because you will see that all those values will be in millions, and finally you need to find the total number of shares. The total number of shares, where can you find?
Record. आगे
From
दे
here also
देता
you can find.
आगे दे देता ज़्यादा
What's the number of
होता
shares
ना।
here?
सीधा तेरा पेन गया, बहुत दूर गिरा दिया।
बाद में उठा ले। आगे क्या पीछे? एक पैर से निकाल ले। प्रियंका, ब्रो उसको पैर से निकाल ले। पैर से।
Okay, guys, one second. Guys, once you find the equity, you need to.
क्या हुआ?
Once you find the total value of equity, you need to divide it by the number of shares. The number of shares you can actually find it from the financial report or from the income statement itself. I request you to find it from the financial report. You search for the number of shares outstanding, you will be able to find it. So in this case, I've taken the approximate amount. So value of equity is this divided by the number of shares I have calculated. Alright, so that's a value per share. We calculated using the model. Okay.
So, number of shares as in all classes of shares or just?
Total number of shares outstanding. Okay. Okay, guys. Now listen. I know this is going to be a task. The ones who have paid attention, you will still have some queries, but most of you will be able to figure it out. You need to first do the free cash flow to the firm currently. Then what you have to do is project the growth rate for the future years. Okay, that you need to do it for 30 years. And 31st to infinity, you can take the 3% growth rate and find that value. And finally, once you project all the future cash flows, you need to discount using the NPV formula. NPV formula is the net present value formula. You can find the total value of the firm. You deduct the total value of debt from it, you will get total value of equity divided by the number of shares. Alright, this is your CIA 3.